ServiceNow. So you may know it as Now, N-O-W. This is one of my favorite tickers for trading because it's one of the really hot cloud computing names. So why does that make it good? Well, for one, it can move on a pretty regular basis with the market, and additionally, because it's in a leading industry group, it will typically move kind of before the rest of the overall indexes do. Additionally, you can typically count on it when it pulls back to rip higher. So for all of those reasons, I like it, especially when you're doing something like out of the money premium. You really don't want to be really worrying when something dips, and when you stick with a stock like this that's a Phoenix stock, that when it dips, it rips immediately after that. That is a much better place to focus as far as premium selling is concerned, because like I said, even if you get a bad day or a bad 2 or 3 days, then you can typically plan on it rallying after that. So why else do I like this stock? Well, it's not currently affected by the overall trade war. So, you will see stocks like this that will dip on bad news. But something like this in this industry group, it typically does dip and then rip after the fact. And at the end of the day, it's really not going to be impacted by the trade war. So not only that, but it also shows quarter over quarter and year over year growth in fundamentals, along with the strong technicals of the chart. So here's a good example of the ServiceNow ticker. You can see that it follows a nice, easy stair-step pattern. It'll pull back to the 21 and up, 50, up, 34, up. This one, yes, it did breach the 50-period simple. But then it turned around and ripped to brand new highs within, it broke through the 50-period simple for 2 days. And then after that, it rallied and went on to a brand new high. So for something like this, if I was in the trade and I was selling premium, I would plan on it sticking with this ripping price pattern after the pullback, and additionally I would sell at these lows. So you can see that after it made the new high, pulled back, new high. So with something like this, because it is such a fast moving stock, it is important to couple that with technical analysis. So I really wouldn't go selling premium blindly on it. I would focus on doing it at least at the 21 EMA. 34 is even better, especially when you're selling out of the money premium with the risk reward as it is. So if you kind of focus on these dips right in here, that one wasn't quite, but it was to the 21. If you focus on these dips to the 21 and the 34 EMA, that's going to give you a much, much, much better edge as far as selling premium is concerned. So let's go ahead and look at our spreadsheet. So as you can see, I plugged in my values in this spreadsheet. It gives us a pretty nice range. And now something that some other people have always also pointed out is, hey, what if I take this the opposite direction? What if instead of selling premium on the outer legs, what if I sell premium right down the middle, and I know the probability and the range at which it's likely to trade? Well, I think that makes a whole lot of sense. I wasn't really focusing on that for this class, but to answer your question, yes, that does make sense to me. So if you're looking at this, you can see the upper and the lower bands. Now, like I was saying about the trend, especially on something with Now, where it's one of those hot flying stocks, if you want to come in and try and sell the upper bands when you're making extensions, you can do that. I think it's more risky. I think it's better to watch the pullback and, try to get into trades on the pullback versus trying to get in on the upside. So let's look at this and compare it to Ulta. So the last one that we went over with Ulta, this was one that, all right, sorry about that. I had to pause that for a minute because I had some other work responsibility I had to tend to. But as I was saying, When you're looking at now, and especially in comparison to Ulta, now's standard deviation credit is much better and also right on point. So when you're looking at this and you're looking at the 265 put, 260, getting an 85-cent credit, I mean, that's right about where I want to be. So looking at that all around, I feel like, especially if I'm trying to compare, like, hey, you have a possibility of Ulta or looking at now, this is much better. The other thing that you can do, obviously, like we've been talking about for this whole class, is you can make your risk reward a little bit better. So instead of using the full standard deviation, you want to do a half standard deviation. And in this instance, because this ticker can be volatile, what I did was I shifted it one more week out. So if you look, you add another week out, you add the put credit spread. So, I mean, you're still $15 out of the money. If you look at this, it's trading at $291 currently. You're still $15 out of the money. You have an expected move of $24, but because the thing has pulled back and it's in an upward trend, you're, looking for that $24 to be to the upside. So that's one way that you can make your risk reward a little bit better. And then, of course, the 5-star method. You can do the 15, which is actually 17 days till expiration. And you can actually make it almost a 1-to-1 risk reward. And so it just kind of depends. It just kind of depends what you're trying to do with it, what type of trading plan you have, what type of risk reward you want. And for me, honestly, when I'm looking at this, I really like to do the ones that are closer in the money, but those also require more management. So choose your own adventure. What do you want? Do you want more management, or do you want something that is going to be further out of the money? So let's go ahead and move on to the next ticker, which is Netflix, and I'll see you in the next chapter.